Good evening, everyone. Thank you for joining us this evening on Applying Technical Analysis to Your Trading. I'm Crystal, the Community Manager at ProsperUs. Let me introduce our speaker for tonight. We have Jeremy, Market Strategist at CGS-CIMB Research. Jeremy has been in the financial markets for over 10 years. He specializes in global macro analysis to spot the long-term trend and employs technical analysis to time the market for optimal entries and exits. He is also the content writer of Transporter, identifying daily trading ideas in the US and Singapore equity markets. ProsperUs is a digital investment service launched this March to cater for the millennials. We aim to provide you with the best in-class service. Our specially curated educational series allow millennials to gain more insights on investing. So with ProsperUs, you will not only learn how to invest, but also enjoy curated lifestyle experiences at the same time. Head over to Google Play or App Store to download our ProsperUs app and start investing today. Follow us on our social media channels to keep yourselves updated on the latest news. Do check out our upcoming sessions on going beyond the China big tech stocks, which companies are worth buying for 2022, live on Sydney, 14 December, 8 p.m., and also Market Outlook 2022 on 13 Jan, 7 p.m. So without further ado, let's start tonight's session. Jeremy, over to you.
All right, thanks a lot for the introduction, Crystal, for that. So once again, thanks for everyone to take your precious time off during dinner to tune into this webinar. So again, my name is Jeremy and I'm the market strategist here at CGS-CIMB Research Singapore. So hopefully today we'll just cover some of the more interesting parts over here. Mainly the key topic will be technical analysis and how we actually apply TA more on a practical kind of application over here than theory that we have actually read on the books. So that is the kind of overlay that we have right here. Hopefully within this 1 hour, we will get through some interesting points. So let me just jump straight through to the slides. Standard disclaimer over here. So key topics that I'll highlight today very quickly. Hopefully over this 45 minutes, we'll cover some interesting points over here. Even though it's something that is very simple, but that actually forms bulk of the technical analysis that I actually use myself, at least in terms of a day-to-day identification of trading ideas, coupling them with a macro view as well as a fundamental view. So 3 key points that we will just cover very briefly in terms of watching some tools that we actually use within TA that is practical will be firstly identifying support and resistance, covering quite a bit about them. That actually forms the core basis of a TA. And then after which identifying trends that would actually kind of improve your trading moving forward if you are still rather new to TA by kind of analyzing chart and then projecting market trends. That is one good trick to actually learn to add into your trading arsenal. And then the third most important element within technical analysis will likely be the application of a relative strength index, how we actually use the RSI to time the market in terms of identifying where the low is in the market or even where the high is for a specific asset class. So that will be the 3 key points that we'll be going through today. Even though it might sound simple, but once you actually kind of apply them as a whole, analyzing them for certain asset class, I will show in a while how they can actually guide the general market moving forward and possibly aid within your trading investment landscape. So very quickly, just what technical analysis is, the plain old simple definition over here, if I were to just take it out from Investopedia, what it shows is TA is trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activities such as price movement and volume. So by itself, it does seem a bit dry, a bit abstract. However, if I were to just phrase it out in my own words, I think what TA to me is basically looking at charts, looking at historical price pattern, and then using them to form a basis as to where we think the certain asset class will actually hit into within the next, say, 2 to 6 months out. So basically what we are trying to do over here is looking at price chart to project price movement moving forward. So at the end of the day, what we try to do over here using TA is to minimize our loss, or at the same time try to amplify our winning probability by identifying trading opportunities from our trading patterns. So today I will just again highlight some of the key tools that we have over here. And hopefully with that, I think that will actually greatly improve your kind of trading moving forward. So just a quick analogy over here, what TA is. So for instance, if I were to draw an analogy of me giving you a piece of map without tools. So for instance, without giving you pen, paper, compass, pretty much the map is useless because you don't really know how to navigate through the jungle. So that is also true for TA. So for instance, a price chart by itself is like the canvas on the map. Without technical analysis, the tools that I mentioned, such as support resistance, trends, moving averages, relative strength index, you are pretty much clueless in terms of where the price chart will actually head to moving forward. However, with the tools that I just mentioned, that could actually help with identifying where we are within the charts and probably where prices are going to head into the near future. So that is how I would kind of see TA employed within the trading side of things. And more importantly for TA, why it is so interesting is it kind of works for all asset classes. So not just for Forex, bonds, equities, indices, commodities. It even works for like cryptocurrency, which is something that is relatively new. And in fact, for cryptocurrency, it actually works better due to the fact that the fundamental side of thing in terms of justifying for intrinsic value for cryptocurrency right now is still pretty obscure, which is why TA kind of still works towards a certain extent, or I would say to a better degree. So in the examples that I will show moving forward, I will also highlight some of this asset class, just to highlight how TA actually works across all asset class, including Bitcoin at the end as well. So do stick to the end for that. So that just kind of forms the basis of what TA is. Pretty different from fundamental analysis, where we do modeling, where we look at earnings growth, earnings trend, looking at cash flow, and then discounting, and then finding an intrinsic value. So TA is a total opposite of that, looking at price chart and then kind of projecting the market movement forward. So it's just a simple tool that we have over here. And I will try my best to actually cover some of the important aspects. So the very first thing, like I mentioned, that I would like to go through would be to explain what support resistance is. Again, for those that are already kind of using TA, you already know how important this is. But basically, support would basically mean level where we will see buying happening. So in other words, support is like a floor where prices tend to actually bounce back higher. And what we can call support, another word for it, we will be calling it like a buy zone, which means every single time when we hit a buy level or the support level, that is where we would like to kind of search out for buying opportunity across this support level. And the flip side of things, resistance would be like a ceiling, where prices tend to actually fall over from the ceiling, and henceforth, that is also where we call a sell zone. When prices kind of hit a ceiling, that is also where we would tend to look out to take profit. Or even for those that are more adventurous that look into shorting for equities, you can actually start looking to short at resistance level. And another key important point for identifying support resistance is the property of it is once a support or resistance is broken, it is likely to turn into the resistance if the support is actually broken, vice versa. So it might sound a bit abstract here, just words. And I will just right now move to the picture that can paint a better kind of 1,000 words right now. So you can see over here, I've drawn some sort of a theoretical price chart over here. So just imagine the blue line over here is a price chart. And I've highlighted some key points. So after explaining what support resistance is, the next question will be, then how do I actually identify a support resistance? So pretty simply, what you would like to actually look out for in the chart in terms of identifying support and resistance would be to look out for key turning points on the chart. So for instance, for a support, what we would like to see is inverted V-shaped bottom. The more obvious the V-shape is within a price chart, usually that would likely become a key support level. And vice versa on the flip side, if we have a major inverted V-shaped top usually that inverted V-shaped point will likely become a resistance. So just to illustrate a point over here, you can see again, like I mentioned, if this blue line, just imagine this as price. So you can see the first support level is identified over here when we actually get this strong V-shaped bottom. Usually how prices tend to react to support resistance is the next retest of this support level. We will likely then see prices start bouncing off this support once again, which is why, like I mentioned in the previous slide, the support level is usually the point where we would like to look for buying opportunities. And for this case, you can see if you start to look to buy around this support level, it will likely show you this kind of a price action where we will likely pinpoint the bottom for this price action movement. And likewise, on the flip side, for resistance point, like I mentioned, you want to look out for inverted V-shaped top. The more obvious it is, the stronger the resistance is. So for this case, you can see a theoretical price movement when price retests a resistance. Usually we will start to see some take profit followed by some pullback. So this is the textbook kind of price action that we would usually see within real life example, which I will show in a while. However, do take note, again, like I mentioned, once we do get price breaking above this resistance, for instance, the next time it does actually retest this level, usually we will likely see this resistance turn into a support, which then means that you would like to look for buying opportunity at this level once again, once we see this kind of breakout move playing out, just purely from a price action perspective, just looking at support and resistance. So that is an illustration of how price chart tends to move. If I were to show you real life example right now with some examples. So this chart over here basically is a Singapore stock, Rex International, which is an oil and gas stock in Singapore. And basically I've kind of drawn the charts over here. This is on a daily time frame, which means every single bar over here represents a day's movement. And again, like I mentioned, if I were to show you this chart without the ability to draw lines and identifying trends, pretty much you wouldn't really know where prices will be heading into, because pretty much you'll be just looking at squiggly lines. However, if you can actually just plot some simple lines on here, it can actually show you something that is much clearer in terms of aiding where we think prices might head into in the near future. So for this case over here, you can see for Rex International, some key points that I would like to highlight over here is the first resistance that we can actually identify would likely be the one over here. Again, like I mentioned, once we see a major V-shaped, inverted V-shaped top forms, that usually would be the point of interest where it will likely become a ceiling, where we will likely see some take profit as well as some selling pressure. So first point over here, we highlighted the 16.5 cents level. Is where we first identify this as a resistance level. And you can see the next retest over here sometime back in early Jan. That is where we started to see some take profit followed by a sell off. So that shows you the exact importance of identifying support and resistance. If you do know that early on, then if you have existing position, what you would usually do is kind of a trim some profit over here once we retest this level at 16.5 cents. And how we will continue to use this level is the moment we actually break out above this point. Remember the previous slide, like I mentioned, once a resistance level is broken, usually when we do get a retest of that level, it would likely turn into a support, which for this case over here, you can see in March, we then retested this previous resistance at 16.5 cents, which eventually turned into a support where we started to see prices rebounding back up higher into an uptrend. So simply by just identifying this resistance level at 16.5 cents, we could actually look out for another buying opportunity over here in March, which then resulted in a rally of 19% over the next 1 month out. So in fact, this particular trade over here, we did identify it within our transporter report back in March. So again, for those that are interested in trading ideas, we do actually publish daily trading ideas across multiple markets. So do check out our iTrade portal for that. But basically for this trade, if you were to follow this particular trending kind of trade setup, what we would like to do is once we enter this trade at 16.5 cents, we would then look to take profit around this level at 19.9 cents, mainly due to the fact that there were resistance that were formed back in June as well as July of 2020. Again, how we will identify major resistance is look back in time. And you can see over here, there were two major inverted V-shaped top that actually formed, which then more or less confirms to us that this is a major resistance, which then over here, you can see prices start to take profit and then turn back into a pullback. So basically, the schematics of how we will identify support and resistance and then using them in real life application, this is one good example over here that I've just highlighted. So another example over here, like I mentioned, using support level as a guide, a buying level where we will actually look for buying opportunity. This is one good example for it. So this is the Straits Times Index on the daily time frame. Again, daily time frame meaning each single bar over here represents a day's movement. So you can see here for the STI, pretty much our first support that was being identified was actually back in May, where we have gotten this strong V-shape kind of a bottom. The support level was first identified at around 3,050 points. And once we actually identify the support level, the game plan moving forward is if we do get a retest of the support level, and if the general uptrend is still intact and healthy, what we will likely do is to look out for buying opportunity at the support level of 3,050 points. So for this case, you can see during the sell-off that we saw earlier on in September through October, we did actually get three good opportunities to actually load up on the STI at this support level at 3,050 points, highlighted here in blue. So all in, if you were to take this trade and just plainly buy off this support level at 3,050 points, you can see the rebound that followed actually managed to see the STI gaining about 6% over the next 1 month out, which is quite a decent return if you were to consider this at least on the index level. So again, this 6% rally pretty much is pretty simple in terms of where we would take profit. Again, we would like to take profit at the resistance level. And for this case, the resistance was highlighted here back in April, where this actually formed an inverted V-shaped top, which qualifies it as a resistance. So it was no surprise that the STI over the past 1 month or so actually fell over from this resistance, which then confirms to us how this application of support resistance worked well in a real life kind of application. So another key point that I would like to highlight is if we do have support coming in through from different factors. So for this case, you can see the STI. This green dotted line over here is the 200-day moving average. You can see how during this period of correction, the STI actually found further support of the 200-day moving average as well in confluence of the 3,050 points. Once we do get the kind of a confluence where we have multiple factors of support coming in at a single point, usually that becomes a rather strong support, and that actually adds on to the probability of that support holding up and your odds of getting that buy trade working way higher. So for this case, it actually worked. And if I were to fast forward to the chart here, and if you have been following the market for the STI, the recent Omicron scare 2 weeks ago actually caused the STI to fall back to this level of 3,050 points. And once again, you can see this support holding up pretty strongly just over the last week as well as this week, where we saw this rebound of this support level at 3,050 points. So again, all in, you can see how the real life application, even just this week, proves that this skill of identifying support and resistance is pretty crucial in terms of guiding you through where the markets might head to with just a kind of a shortcut glance looking at the charts. So with that said, the first important tool, again, support resistance, done. The next more important point over here will be to identify trends. So very simply, trends-wise, there are 3 trends to note. The more important one will be to identify an uptrend where prices are heading higher. And then the second trend will be a downtrend where prices are heading lower. And then the third trend, which I would consider would be something that we call a consolidation or a range, where prices just trade sideways between range high as well as a range low within a box heading nowhere. So more importantly, I think for traders, the easier trend to trade would be something of an uptrend. So what we would do is once we identify a particular asset class that is moving in an uptrend, what we would like to do is to wait out for any form of pullback, any form of a correction, and then to buy on the weakness and to continue to trade along the uptrend as it continues to move to the upside. So just a theoretical way of identifying trends. So for this case over here, we would use the NASDAQ 100 index, the tech-heavy NASDAQ in the US market as an example over here. So this is the Nasdaq 100 on the weekly time frame chart, going back to 2011. So you can see how we highlight the uptrend is watching how prices are forming. So for this case over here, a clear definition of an uptrend is when we have an asset class forming a series of higher highs as well as higher lows. And as for this case over here, you can see we initially pinpointed this high point over here back in 2011, as well as this low point here in September. The moment we see the price chart starts to actually break out to the upside, forming a higher high point in relation to this previous high, and then after which forming a next higher low point in relation to this previous low. Pretty much this is enough to qualify this particular asset class in terms of it moving into an uptrend. And once we have the configuration of prices moving in this higher highs and higher lows kind of sequence, then you can see generally the price will continue to move within an uptrend. And for this case, you can see the Nasdaq continue to move to an uptrend over the past 8 to 10 years out. So that is just the definition of how to identify a trend here, more specifically an uptrend. This is more of I would say, a more difficult way of identifying a trend. If you want to look at the shortcut of identifying a trend, we would like to use the moving average to actually identify a trend. So the quick shortcut in terms of identifying a trend using moving averages would be, firstly, plot the moving averages on your chart. So the parameters that I would like to use over here would be a 20-day moving average as well as a 60-day moving average. So why you would ask why 20 and 60? So I think the plain simple answer for this is 20-day represents 1 trading month, and then 60-day represents 3 trading months, which then kind of works pretty well in terms of how I monitor the charts here moving out. And a easy way of identifying an uptrend is when we do have a 20-day moving average that is above the 60-day moving average. And then vice versa for a downtrend is when we have the 20-day moving average below the 60-day moving average. So that kind of gives you an easy guide in terms of identifying a trend. And what we would like to do again is identify a particular asset class that is moving in an uptrend. And once that is identified, once we do have a nice uptrending asset class that has a strong fundamentals, then the strategy moving forward will be pretty simple. We would then wait out for pullbacks for correction to happen. And in terms of levels that we will be looking out to buy on the dip, a good reference point to start to look out for buying opportunities will be somewhere near the 20-day moving average as well as the 60-day moving average. So it might sound a bit obscure again with just words. So right now I'll just jump straight through to some chart example. So bouncing back to the Singapore equity market, this stock over here, ProsperUs, which is a realty broker here in Singapore, which have done pretty well over the past 2 years, if you ask me. Chart has been moving nicely within an uptrend. So this is a good example over here that I can highlight how you would use moving averages to highlight an uptrend. And after identifying an uptrend, how you would actually use these moving averages to trade an uptrend. So just follow me on the chart over here. This is a daily time frame as well. So each bar represents a day's movement. So again, first and foremost over here, once we do get a bullish crossover signal, what it means is the 20-day moving average starts to cross or cut above the 20-day moving average. That is usually the first point where we will identify the chart bottoming out and confirming an uptrend is forming. So over here in May of this year, that is actually when we saw this particular bullish price action forming. This actually qualifies this uptrend forming. And once we kind of see the uptrend forming, the next likely strategy, like I mentioned, is to wait out for any form of pullback to happen. And once we see a pullback down to our buying level, which is the 20-day moving average as well as the 60-day moving average, then we will likely pull the trigger to look out for buying opportunity to ride along the uptrend. So I've highlighted here on the chart a few points that you would consider as a buying opportunity or a buy zone. So there are actually 4 good examples where ProsperUs actually presented a good buying opportunities during periods of correction and pullbacks. And you can see each example over here actually gave back a return of 12 to 25% following the bounce back above the 20 and 60-day moving average. So that is usually how we would like to trade strong uptrending stock with good fundamentals. And this is a kind of a textbook kind of example that we would like to follow as well for stocks that have this kind of a trade setup. So if you look at some of the US stocks that are also moving in this kind of a configuration, usually this 20 and 60-day moving average playbook plays out very well. So for example, if you were to look at Apple, if you were to look at AMD, if you were to look at Amazon, Microsoft, Google, most of the chart setup are following this kind of a move where it's continued to trend higher to the upside, while the 20 and 60-day moving average tend to actually become the floor for this uptrend, where it actually tends to bounce off every single time we do get some sort of a pullback. So in terms of strategy-wise, I think do look out for that kind of stocks that have a nice uptrend. And every single time we do get any form of pullback to the 20 and 60-day moving average, then that will likely become our reference for buying to continue to ride on to the uptrend as long as the fundamentals remain strong and as long as the uptrend remains intact. So moving on to this example, again showing you how we use the moving averages to identify an uptrend and to use the moving averages to identify buying levels. So right now we just moved to the commodity example. So previously I've been showing example for equities, be it single stock or equity indexes. Right now over here on the chart, we are using Brent crude oil as an example, which is a commodity. So you can see how versatile TA is. You can actually just blanket and use them across all different asset class as long as there is volume that isn't too illiquid. So for this case, for Brent oil, you can see our uptrend was first identified here back in last year, sometime back in November, where we got this bullish crossover signal. Again, what I mean is bullish crossover signal is when we have the 20-day moving average crossing back above the 60-day moving average for the first time, which then qualifies us for this particular asset class, Brent crude oil, turning back into an uptrend in a very early stage. So again, once we kind of identify the uptrend playing out, the next thing that we would like to do is then wait out for buying opportunity, where we do get some form of a pullback back down to, again, the two key levels that I mentioned, the 20-day moving average as well as the 60-day moving average, which is the 20-day, the red line, followed by the blue line over here respectively. So you can see over the time span of the past 1 year and 2 months out, we have gotten quite a bit of good example in terms of buying at those levels. 1, 2, 3, 4, 5, 6 good examples of prices bouncing off this 20 and 60-day moving average, which then racked in average gain of around 13 to 21% purely just by using this strategy. So I didn't really cover the 200-day moving average. So I think just to summarize in terms of how we would use the moving averages, 3 moving averages is more than enough in terms of being applied onto the chart. And again, like I mentioned, once we have identified an uptrend, how I would kind of layer my trades when we do get some form of pullback is the first level of buying, we will place it at the 20-day moving average. If it does pull back further, then the next level of buying would be the 60-day moving average. And in the worst case scenario, if prices continue to fall below the 60-day moving average, which is the blue line, the last line of defense would be the 200-day moving average, which would likely hold if the general uptrend is still intact. So you can see for this case over here, sometime back in July over here, where Brent oil actually crashed down pretty badly. Despite breaking below the 60-day moving average, the blue line, we can see the 200-day moving average held up almost to the cent, and then eventually lead to this definitive bottom, followed by this 13% rally as well as the 21% rally moving forward. So again, just by using the moving averages, you can actually find points on the charts to actually limit on downside and to identify good buying opportunities that could actually stack towards your favor. So purely, I think right now you have more or less see how moving averages work pretty simply, just by using them to gauge the uptrend as well as using them in terms of identifying buying opportunities. So an uptrend is usually the one that we would like to trade. For those that are more adventurous that would like to look out for shorting opportunities, pretty much the example is the same. Just flip it around and probably you get an understanding of how to use a downtrend kind of configuration here if you were to trade a downtrend using moving averages. So for this case, to highlight the downtrending kind of trade examples. SIA will be the example that I'll be using here. Similarly, on the daily time frame, so this sell-off of this downtrend actually happened during the early stages of the COVID that was identified back in early 2020, where we started to see major economy worlds around actually enter into a lockdown kind of mode, which then led to SIA actually kind of cratering down into this downtrend. And during this period of a bear market for SIA, you can see how the technical analysis aspect actually also works pretty nicely in terms of guiding the general trend moving forward. So you can see over here, just before the market actually fell into a bear market, sometime back in December, when we actually get the bearish crossover signal, where the 20-day moving average starts to cut below the 60-day. And then once we do get the bearish signal over here, you can see prices just start to turn down lower and continue to trend lower in a very staggering manner. But more importantly is how the 20 and 60-day moving average tends to become a major ceiling here once we turn into a downtrend. And what I mean by that is every single rebound that we saw during this period of bear market, the 20 as well as the 60-day moving average then becomes the ceiling here that caps the upside. So for those that have existing position for SIA during this period, if you were trading the bottom, trying to catch the bottom or the falling knife, a good way to actually use the moving average would be to look out for take profits whenever we see SIA actually bouncing back above the 20-day moving average or the 60-day moving average. You can see over here, especially in the April rebound to September period, every single rebound back up was kind of firmly knocked down by the 20 or 60-day moving average, which then lead prices back down into the downtrend. So henceforth, a good way to actually use the 20 and 60-day moving average in a downtrend is to look out for those levels as a reference point to take profit, or for those that are actually more adventurous in terms of shorting the market, taking a directional bet to the downside. You can actually look out for selling opportunities at the 20 and 60-day moving average for this instance, if we do have a downtrending kind of a trade setup. So that is pretty much how you will use moving average to trade an uptrend or a downtrend. And then moving on, again, the third trend that I just mentioned would be to watch out for consolidation or a ranging kind of a pattern. So for this case, I will highlight the Dow Jones Industrial Average. Similarly, also on the daily time frame chart. So you can see this is a more recent example for the Dow Jones Industrial Average throughout the period of September as well as October. The market movement was pretty much muted here for the Dow. So what happened was for the Dow, it pretty much traded within a box, bouncing back and forth within this range. And for this case, you can see the floor was around 33,480 points, and then the ceiling was around 34,900 points. So how you would actually trade a consolidation or a range is firstly to wait out for it to break out above this box. And once we do get a breakout move, usually for this case, prices tend to actually continue to move within the breakout point. And once that happens, you can see for the Dow Jones Industrial Average, once we do get this breakout move, you can see the Dow just continue to trade within this uptrend with a good rally of 3.5% over the next 3 weeks or so. So this 3.5% by itself doesn't really look that attractive, but do note that this is actually one of the large cap indices in the US. So 3.5% does actually represent quite a lot for our indices. So in terms of how you would trade a consolidation, we will actually wait out for this kind of scenario to play out. And once we do get a breakout move, then we will trade accordingly in the breakout move that happened. And for this case, we would like to look for buying opportunity following this breakout move over here, which would then kind of gain us a good 3.5% gain over here for the Dow as an example. So this is a bullish breakout scenario example. We also have a bearish breakout kind of a scenario over here that we highlighted for the Hang Seng Index, which is the Hong Kong equity index. So for this case, it's basically just the flip side of it. For the Hang Seng Index, you can see over here, sometime back in March this year, we have entered into this consolidation range for a whopping 15 weeks, pretty much trading sideways between this range of 27,720 points being the floor. And then the ceiling over here will be somewhere near 29,400 points. And again, like I mentioned, how we would like to trade consolidation is to wait out for a breakout move to play out. And for this case, you can see the moment this Hang Seng Index actually break to the downside over here sometime back in July, it eventually led to this kind of bear market where prices start to head into the next leg lower, where the Hang Seng Index actually fell a staggering 12% over the next 3 months out. So again, for those that are more adventurous, that actually look out for trading opportunity, you can actually look into the CFD to capitalize on this particular move to trade to the downside for a short kind of opportunity. And that would have actually you a good 12% play here over the good time frame of 3 months. So basically, just to wrap up, there are 3 different ways of trading trend. Uptrend, downtrend, purely just using the moving averages as an example. And then for consolidation, we would use the breakout point as the guide to actually tell us where prices are heading to in the near future. So those are some of the key examples that I just highlighted, which I think is important in terms of guiding where an asset class is heading into. And basically knowing what the trend is would kind of greatly help investors in terms of navigating the landscape moving forward. And right now, the last important tool that I would use a lot in my own trading decision or trading mindset would be to look at the relative strength index, in short, what we call RSI. So basically, RSI, at least in terms of definition-wise, is an oscillator indicator, which measures momentum. So basically, it's supposed to kind of range between a low end of 0 to 100, but usually it don't really fall to those extreme points. And how we actually identify buy or sell level is to watch the RSI. For this case, over here, the bottom panel, this black line, anything above 70 is what we call an overbought condition. And anything below 30 is what we call an oversold condition. So I think for most people, most investors, you have actually heard this term of buy low, sell high. And that is supposed to be the strategy for most investors. But again, having such a big term of buy low, sell high, I think is something that is pretty reckless, because what low is pretty much something that is unmeasurable by itself. But if you were to look at some of the technical indicators over here, I think it does actually help us in terms of measuring what low is and what high is. So for this case, I think using RSI as a indicator over here, what we mean by buy low is when we do have an RSI that is actually below 30. And usually for this case, for an RSI that is actually below 30, I think usually if you were to look at the price chart, whenever the RSI is below 30, we will eventually get a bottom playing out real soon, if not some form of a technical rebound playing out. So for this case over here, the STI, you can see once we fall into an oversold level over here, the RSI tend to actually rebound higher. A good example here is in June as well as in October. And the corresponding move is, you can see we do get some technical rebound higher here for the STI during the corresponding movement as well. And on the flip side of things, when we do get something that is way overbought, anything that is above 70, a good strategy is for investors that have underlying position is to kind of look out for some selling opportunity in terms of trimming our existing position, taking some profit off the table. That will be some wise decision to take, which I'll show in a while how we actually apply them in real life examples. So firstly, I'll just like to highlight how we use RSI in terms of taking profit kind of a scenario over here. So again, for an RSI that's actually above 70, that's what we call an overbought market, which usually signal to us that imminent correction is playing out real soon. So for this case over here, we have DBS Bank, one of the top banks in Singapore. So you can see over here, I've highlighted some key points on the chart. This is an example going back to 2018. So you can see here when we have an RSI that's above 70, that is first warning sign that it's overbought and a correction is playing out on the horizon. If we were to couple that with identifying key price action here, for this case, we'll be identifying bearish price action. If we were to spot some bearish price action in conjunction with the RSI signaling an overbought condition, usually that is when we will start to see the correction playing out, thereby leading to a sell-off. So for this case, we have highlighted 3 good examples over here. Once in January, once in February, and then once more in April. 3 of such example actually lead to a nice pullback of around 6 to 18% due to the fact that it's firstly overbought, And then secondly, due to the fact that we saw some major bearish price action showing up. So that is how we would kind of use the RSI in conjunction with price action to look out for selling opportunities for those that are, again, more adventurous in taking risks, in betting the market to the downside using CFD, or for those that already have, for instance, existing position on DBS. When we do get such an overbought signaling, then during those periods, we would like to kind of trim your position by taking profit along the way. So this is an example. Another good example for more recent relevance would be to look at this stock Tesla. You can see over here, I've highlighted some key points as well. So recently, Tesla actually experienced some sharp pullback as well, falling about 20% or so. And I guess it's not so much unexpected if you have applied using the RSI and watch how the RSI has been transpiring over the past few weeks or months. So for this case over here, you can see Tesla Inc., which is the largest EV company in the world. For this case over here, I've highlighted 3 key points. So you can see, again, like I mentioned, anything above 70 is overbought kind of market where we do expect a pullback to play out. So for Tesla Inc., back last year as well as early this year, we actually got 2 examples of this overbought signaling eventually leading to a pullback. Once in September of last year where the RSI hit a high of around 84, and then once more in early Jan where we saw that RSI hitting a high of 83. Eventually, you can see Tesla actually top over, followed by a pullback around 30% to 33% respectively. So if I were to move to the recent example over here, more recently back in November, where we saw Tesla Inc. actually had a mere top move to the upside, hitting a high of around $1,200. During those periods, we have already been warning possible pullback playing out for Tesla Inc., mainly due to the fact that if you were to look at the relative strength index, it's way higher above the previous overbought level that we saw back earlier in the year. So in fact, you can see for Tesla Inc., the recent high in terms of where the RSI hit to was actually somewhere near 94. And eventually that actually caused Tesla Inc. to actually crumble down lower, leading to this 20% pullback that we saw playing out earlier in November. So again, how we would use this particular indicator in terms of real life example or practical terms is for those investors that already have existing position in Tesla. What you would like to do is, for instance, when we see such an overbought signaling, and once we see Tesla hitting possibly somewhere near $1,200 as a resistance point, that is probably the point that we would like to take some profit off the table in anticipation of the pullback, which then played out. So again, you can see how just by monitoring the RSI gives you an edge here in terms of possibly calling for a market top, followed by some form of a pullback. And then right now, moving on to the flip side of things, looking at some oversold kind of a signaling. So basically, looking at oversold signaling is just the opposite of how we would use an overbought signaling. So for this case, anything that is below 30 for the RSI is what we call an oversold market. And usually once we do get an oversold kind of a signaling, it also means that eventual rebound is likely going to play out. And what you would like to do as an investor or a trader is to kind of look out for buying opportunities once we see some sort of RSI that is actually below 30. So for this case over here, we are watching the Straits Times Index on the daily time frame. Example from 2017 to 2018. You can see here we highlighted 3 points over here where the RSI fell to the oversold level. So mainly falling to around 25 in June 2017, and then 27 on 2 occasions in September as well as October of 2018. You can see all 3 examples eventually lead to a mean reversion higher for the RSI, which also then corresponded to a rebound higher here in prices, bouncing above 3% to 5%. So again, that is how you would like to kind of watch out for buying opportunity in terms of buying low and selling high. And again, like I mentioned, buying low, a good example or a good guide would be to look out for an RSI that is below 30, and selling high would be to look out for an RSI when we have an RSI that's actually above 70. So then that actually gives you a good guide in terms of what buying low is and what selling high is, purely just by looking at the RSI. And if you want to bring it up a notch, then looking at where the support resistance level is, that will likely give you a further edge in terms of timing the exact bottom or the exact top. So right now, I'll just put it all together. I've kind of highlighted quite a lot of examples here. Again, boils back to three very simple tools that I've mentioned. First one will be identifying of support and resistance. So second one of all will be to identify trends, mainly by using moving averages. And then third of all is to identify where are the buy and sell levels, looking at the relative strength index if it's overbought or oversold. So right now, I will just kind of put it all together so that it is more relevant, and you can see how we apply TA as a whole. A good example over here that I would like to highlight would be to look out for this stock here, Facebook, ticker code FB, recently renamed to Meta platform. So for this stock, for instance, if you are investors that is already rather bullish on Facebook, due to the fact that you are also bullish on this new wave of metaverse theme that will likely be the next Internet of Things, probably moving forward for the next 5 to 10 years out. And you still do believe that Facebook will be relevant then and being the market leader for the next 5 to 10 years out, then how we would actually use TA to support this is to use TA to identify good buying opportunity. And for this case, our US research partner continues to have a strong buy rating on Facebook, with a target price of $410. So that firstly will kind of forms the fundamental view that for the next 12 months out, we still have a strong positive fundamental aspect of Facebook with a target price of $410. And then with that set aside, then we would like to look at the TA side of things in terms of how we would kind of time the market in terms of buying the bottom. So let me just run through very quickly some key aspect here, looking at the chart as to how we managed to actually identify these three buying opportunities here on Facebook here, going all the way back to the COVID low of March. So the first buying opportunity we managed to highlight over here was during the depths of the COVID lockdown in period of March. Again, the lockdown scare from COVID-19 back in the first innings of March actually caused most of the equity market to actually crumble to bear market territory. So without exception, Facebook also fell pretty deeply during this period. But nonetheless, again, if you were to look at the technical side of things, looking at the RSI, you roughly would know where we are in terms of trading closer to the bottom or closer to the top. And for this case, you can see once we saw the relative strength index actually falling to this oversold level of around 25 sometime in mid-March, that is also the point where we would like to start to look out for buying opportunities here if we are still rather bullish on the fundamental thesis on Facebook. So you can see once we fall to this oversold low of 25, eventually it led to this strong rebound higher here for Facebook Inc., following some breakout move that happened. So if I were to zoom in closer and take a closer look during this period of March, the buy opportunity or the buy signal will likely be triggered once we actually see the breakout move above this 2-week range over here. And that will likely become the first buying opportunity that I just mentioned, mainly by identifying how oversold it is, following the breakout move that I mentioned. For those that are more advanced in terms of applying TA, the next set of things that we will look out for is individual price action that we would like to highlight. But that is actually another topic by itself, which we could cover for 1 hour. So I wouldn't really go too much into it, but basically in terms of the broad base, how we actually look at the chart, again, buying low would likely mean to look out for an RSI that's actually oversold. And for this case, we actually managed to time the bottom pretty nicely here back in March by looking at the RSI being oversold. And you can see how Facebook actually played out during this period over here, managing to actually capture around 87% rally over the next 6 to 7 months out, following that bottoming move as signaled by the RSI. So another good example over here, more recent one, would be sometime back in early January of this year, where Facebook started to see some pullback as well, which then led to this, again, RSI falling to this oversold low of around 29. So again, first and foremost, once we see the RSI flashing oversold signaling, that will likely be the first warning sign to look out for buying opportunities. And once we have that in mind, you can see if I were to stack on the first key point that I just mentioned, support level over here, you can see for Facebook, we managed to actually identify a key support here. Firstly, back in September of 2020, where it first formed this V-shaped bottom. So that by itself has already qualified this to be the support level that we would be looking up for buying opportunity. And for this case, it actually stacked in nicely when we have an oversold signaling where prices rebounded pretty nicely off the floor of $245 being this current support. So purely just by using support as well as this oversold signaling, we are managed to actually time this bottom here for Facebook, followed by this strong rally over the next 7 to 8 months out that actually managed to again capture this good 47% gain over here for Facebook. So another key support that actually played out during this period here in January of this year, if you were to purely just look at the 200-day moving average, which is the green line, like I mentioned, there are 3 buying levels if you were to look at the moving average. And the last line of defense usually is the 200-day moving average. You can see how this last line of defense over here, the 200-day moving average, also coincides with this support at $245, further making this a strong support, which then makes this a good case of buying here, which then played out pretty nicely for this particular example. So as a whole, you can see how everything starts to kind of jive together. Once you have the ability to identify support and resistance, trading them along the moving averages, as well as buying them when we are seeing some sort of oversold signaling looking at the relative strength index. So this is a rather good example here. Buy number 2 here is a good example where we kind of combining all 3 elements into one, which then managed to show us a good return of 47%, calling this bottom over here sometime back in early Jan. So moving on to right now, the more recent example here, we also managed to call some sort of a bottom here, which is still currently playing out. So for those that are still active within the market, you can continue to watch this space, whether this particular trading setup works. So right now for Facebook or Meta platform, it's right now trading right at the 200-day moving average level. However, again, if we were to look at the bigger picture, we are right now trading at 2 key points. Firstly, it has been oversold recently in October. So that by itself presents us being within the buying low kind of territory. And then the second point of all is, again, we are right now trading at the last line of defense, which is the 200-day moving average. And right now we are still trading rather strongly above the 200-day moving average, which still supports the case where the long-term uptrend is still intact. So possibly right now, this buy opportunity 3 is still going on live. And again, for those that are still probably new to this technical analysis side of things, probably this is one to watch right now as we are trading right probably at a sweet spot at the bottom end of things where we think this is the low point. And for Facebook, probably it's right for a rebound moving forward, possibly into 2022 first half. So that is how we will kind of apply TA as a whole. And right now, just to summarize again, so 3 key points. What we like to do is for beginners or for those that would like to have an easy way of trading, even for myself, what I would like to do is to firstly highlight stocks that have a very nice uptrend. And again, what I mean by uptrend is for a certain asset class, for the 20-day moving average that is above 60-day moving average, that by itself will qualify an uptrend for this particular asset class. And once we have an uptrend, that is point number 1. What we would like to do then is to buy low. And what we mean by buying low is either buying at a support level. Second of all is either buying at the moving averages that I mentioned, 20, 60, or 200-day moving average. For this case, if you are trading within a very nice uptrend. And then last but not least, again, buying when we have an RSI that's actually below 30. So what is best, again, is when we have all 3 points over here that is coming in at the same time. So for instance, like I showed you in the previous chart for Facebook, the early January example, these three factors actually coincided all together at once, which then resulted in a very successful trade over there, where we have actually prices trading at a support level, and also at the same time at the 200-day moving average, where we also have an oversold signaling, which then led to a kind of a successful trade, like I mentioned. So, and then after which, having a buy trade that is being set up, the next question will be, where would I be looking to take profit? Key or a simple guide over here will be taking profit at resistance level, which is the ceiling, like I mentioned. That is 1 point. And then the second shortcut over here, if you were to look to take profit, if you have any good existing profit or existing position on a certain equity, is to look out for an RSI that's actually overbought. And usually when we have an overbought RSI, there's actually somewhere that we are closer to the top and where price is starting to kind of taper over. So those will be the level that we will be looking to take profit once we actually in a certain trade. So that will be the summary, and probably just one last example before we go to Q&A. So if you do have any more questions after I wrap up, do pop them into the chat session. Then we will likely answer all of them to our best ability at the end. But before that, let me just put together one last chart over here, which is to look at Bitcoin. So like I mentioned earlier on, TA works rather well across all asset class, especially within the crypto market, mainly due to the fact that it's a relatively new asset class. And in terms of placing an intrinsic value over here for cryptocurrency is one that is still rather unclear and obscure right now, which is why if you were to look at TA, where most people are applying it into, it tends to actually work rather well as well. So for this case, again, putting everything together, looking at support resistance, looking at moving averages, looking at relative strength index, we can actually kind of pinpoint some trading examples here for Bitcoin more recently here. So for this case over here for Bitcoin, you can see we actually managed to identify a buying opportunity here somewhere back in late September, early October-ish period, after we actually fell into a period of pullback. So key support level wise, in terms of identifying this as a buying opportunity, mainly stems from the fact that around this level over here, around $40,900-ish region here, this used to be a key resistance back in June. And again, like I mentioned, once the resistance is broken, the next time we actually revisit a resistance, it would usually become a key support level. And for this case, you can see Bitcoin actually held up pretty nicely at around this 41,000 mark. And also at the same time, the moving averages that we will look to buy for our uptrending stock or uptrending asset class, for this case, Bitcoin. You can see the last level of defense, which is the 200-day moving average, this green dotted line, held up pretty nicely as well. So which is why you see once we do have a kind of a key support level stacking in line with a key moving average, for this case, the 200-day moving average, you can see how this actually play in pretty nicely in terms of guiding us to actually look for buying opportunity here sometime back in late September over here. And if you have taken off this trade somewhere around this $41,000 region here, you will likely continue to trade this all the way up until the point where we were overbought. And again, like I mentioned, once it's overbought, that is usually when we would like to take profit, as a correction would likely transpire or play out. And for this case, the take profit level that we would like to have for this trade would be where the previous resistance was at, which is somewhere near $64,900. So that was actually the prior record high for Bitcoin, and also a major inverted V-shaped top, which then qualifies this as a major ceiling. So if you have taken this trade, again, going through the train of thought, like I just mentioned, this particular trade on Bitcoin would kind of manage to get you a good profit of around 47% over a short time frame of around 3 weeks or so. And you can see how the recent price action for Bitcoin has actually played out. This overhead resistance actually helped pretty nicely. And right now, I think Bitcoin is trading just slightly below 50,000 or so. So all in, you can see how this ceiling at this previous high of around $64,900 is holding up pretty nicely, even just by identifying, again, some major resistance or support level. So hopefully, I think all in right now, it shows you a pretty good understanding of how to apply TA on just using 3 simple factors here, looking at support resistance, looking at moving averages, using trends, and then also at the same time using relative strength index to time your entries as well as exit when it's actually overbought. Yep, so with that, I think I've covered quite a lot. Right now, I think we will jump straight to Q&A. I'll pass the time back to Crystal.
Yeah, thanks, Jeremy. I understand it's a little bit past 9 p.m., so we'll try our best to answer all questions posted. So can we take a look at the first question? Would you modify the 20 and 60 days moving average for cryptocurrencies, given they trade 24/7?
Yep, I think that is a relevant question that you pointed out, since the crypto market is something that is slightly different. However, I guess right now, most technical analysts out there actually just still follows this standard default number of 20 and 60, or I would say most default actually follow 20 and 50, which is why I think there is no need to actually alter this moving average number despite the crypto market trading within a 24/7 kind of a setup. And in fact, if you were to look at the price action chart on the cryptocurrency market, the 20 and 60-day moving average does actually work pretty well going back to history. So it does look like the market is still respecting this current parameter that most kind of expert out there is still using.
Thanks, Jeremy. Okay, let's move on to the second question. May I ask how the RSI is calculated?
Yep. So I think for that, you don't really need to know too much about how the calculation works. But basically, the gist of it for RSI is basically we calculate the average strength of the price chart over the past 14 days. And usually 14 days time period is the average that the standard norm that everybody uses. And what it measures is basically momentum over there. And usually if we have streaks of gains, that is usually when we have the RSI that is nearing the overbought level faster than normal, and so forth, which is why this momentum indicator is interesting, because if we have some securities that have been, for instance, trading in a winning streak for say a past 7 days, usually that will qualify it to be an overbought kind of a signaling, which would then call for some sort of correction or a mean revision, because it is almost unlikely that we would likely see a good 14 days winning streak for a certain asset class. So I think in short, there is no need to know the calculation behind it, because it doesn't really aid in terms of the trading decision moving forward.
Thanks, Jeremy. I think we have a few more questions. Most analysts uses 20 and 50, while you prefer 20 and 60. Will the interpretation be affected?
Yep, so I guess that is valid as well. And in fact, I think I'm the only one that uses the 60-day moving average instead of 50. However, like I mentioned, the key reasoning behind 60-day is just 60 days moving average is basically 3 trading months, whereas 20 days is 1 trading month. So it's just a round up number over there. However, the 60-day as compared to the 50-day moving average, if you were to plot it out on the chart, it doesn't really make much of a difference. At most, you are probably losing out maybe in terms of difference, a very small amount of say 0.5% in terms of where it's being drawn on the chart, which if you were to look at the grand scheme of things, it doesn't really change much in terms of changing how the TA works.
Okay, thank you. Can we take a look at the next question? Please share on TA for IPO share. When would we apply TA?
Yep, so for that, unfortunately, TA won't be able to help out for newly listed stock, because again, TA is a study of history, especially price chart. So I guess for newly listed stocks, what works would be for the IPO stock to actually, say for instance, have good to 2 to 3 months worth of trading data first before then TA would be valid. But in short, if it's just something that is newly IPO, I think TA doesn't really help out in terms of identifying where the particular stock will be trading at.
Shall we take a look at the next question? If the candlesticks goes past the 200 moving average, does it mean that we should no longer hold it, or should we see if it will go back up, and for how long it has been in an upward trend?
Yep, yeah, I think this is a valid question as well. So again, I think as a whole, using the 200-day moving average in relative to where prices are trading at is just a brief gauge. Sometimes we do get overshoot to the downside for uptrending stock below the 200-day moving average. However, if you were to just use that as an example and kind of stop your trade just below a 200-day moving average, it might be too premature for that case. So a good example is if you have a very strong belief fundamentally in a certain stock, for instance, say Apple, which have pretty strong fundamentals as well, and most hedge funds are heavily vested in Apple. Stocks like that have good fundamentals in the long run, usually even during periods where prices are falling below the 200-day moving average, I would still say the uptrend is still intact. And how we would actually use TA to actually minimize our downside would be monitor again where the RSI is during those periods. If prices are below the 200-day moving average, and if we are still not yet oversold, Then how we would trade that is to wait out for prices to actually fall to the level where it's oversold, and then look for buying opportunities near the next support level. And the next confirmation for the uptrend resuming will be the point where prices start to recover back above the 200-day moving average. So I think in short, another key bonus over here that I can give is for such example, especially when we have like a bear market during the lockdown of 2020 due to COVID, when most prices are below the 200-day moving average. For more conservative trader that would like to trade back into the uptrend, a good example is to wait out for prices to recover back above the 200-day moving average before you look out for buying opportunities.
Okay, thanks, Jeremy. Let's take a look at the next question. For RSI, why are there different values and what do they mean? For example, RSI 6, 12, and 24.
Yep. So basically what the difference is the time period that you're using. So basically, again, like I mentioned, the industry standard that everyone uses is 14-day, which is 2 weeks. 6 and 24, like you mentioned, again, then it will be tailored more towards different asset class that you're looking at. For instance, for things that are more volatile, you will likely use something that is more longer term horizon for looking at the RSI. And for something that is probably less volatile, you look at the RSI that's actually a shorter time frame. But all in, I think it is still better to stick towards looking at the RSI with time period of 14, mainly due to the fact that that is the industry standard, and that is usually what most traders, most investors, as well as most hedge funds are looking at. So as a whole, again, blanket kind of statement over here is for TA, what we would like to do is to use something that is widely used or most commonly used by the industry out there. So it's best not to actually tweak the parameters over here, as probably it might not work as effectively as the standard numbers that we actually use.
Okay, let's take a look at the next question. Which indicator is more reliable, RSI or, sorry, I don't know how to pronounce it.
No worries. Yep, so for this case, I think both works as well. Sometimes one lead the other, while the other lacks. So there isn't one standard answer to that. But for my case over here, the reason why I don't really use both is because usually when one confirms, the other will confirm as well. So either you be using a stochastic or RSI, I think it's just best to stick to one, and the application of it is more or less the same.
Okay. Will there be instances whereby they actually contradict each other?
Not really, because if you were to look at the mathematical calculation behind them, they actually use the same derivative, which is why usually they actually kind of show you the same thing, just that it's in a slightly different form.
Okay, thank you. Can we take a look at the next question? Sorry, I think we have quite a number of questions streaming in.
No worries.
How do we make use of volume in TA? And why is your technical analysis with RSI indicator, you don't use the volume bar?
Yep. So I guess for that case, volume works better with individual securities. I left that out because it kind of obstruct the chart a bit, but in my own analysis or my reports that I write, yes, volume does play a very big part in terms of watching where prices are heading into. More importantly is you want something that has a nice trending volume, or something that has an increasing volume to show you that the day's movement is something of significance. And that therefore, I think the short answer to that is volume is important for TA, more so for individual stocks than for indices. Because for indices, I think that as a whole, volume calculation will be a bit tricky because it's not as representative as it is. But all in, I think the number one thing, like I mentioned, is still the 3 points that I just mentioned: support, resistance, moving averages, as well as RSI. And then once you have that mastered, you then add on the volume to actually see how the day's movement is and corresponds to the volume. And what we would like to see is something like prices of interest with combination of a volume that's actually rising, that will likely increase the odds of the trade actually working out.
Thanks, Jeremy. Let's move on to the next question. Is Ichimoku useful in TA? And also, is Fibonacci a useful tool in TA?
Yep, so definitely they are useful to a certain extent. The reason why I didn't include them in is because I do use them myself as well, but they are, I would say, secondary to the primary thing that I just mentioned. So if you like something to further add on to this trading arsenal that I've just mentioned, yes, Ichimoku does help to a certain extent, as well as Fibonacci to a certain extent in terms of identifying turning points, support and resistance. But if you were to kind of plot your chart up with everything over there, for instance, looking at stochastic, looking at Ichimoku, throwing in Fibonacci all into the chart, at the end of the day, you'll just be kind of overthrown with data to a point where your chart might not be actually analyzable. So I would still advise to probably stick to the chart that is clean first and then have a view. And then after which, probably have a secondary view by using your Ichimoku as well as Fibonacci to further substantiate your analysis.
Okay, let's move on to the next question. Most times, the RSI for most instruments stays above 70 and below 30 for a long time. Using these 30-70 levels would result in premature exits or premature entries.
Yep. So for this case, yes, it does apply more so for stocks that are trending in a very sharp fashion. So for instance, Tesla is one that can actually backfire if you were to use this case, which is also the reason why I've mentioned the other part that forms this strategy would be to look at individual price action. So that is something that is more advanced over here that is, again, like I mentioned, a topic for another day, which I can cover for an hour, because if you were to look at individual price bar, that actually gives us some sort of predictive power in terms of analyzing the chart. So again, when we are doing TA over here, we are not looking at just one parameter. Say if it's overbought, we would take profit. If it's oversold, we would buy, but more so as a combination in terms of where it's trading, in terms of support resistance, and more importantly, in terms of individual price action. So for instance, over here, we wouldn't be looking for buying levels when we have an oversold stock if we are not seeing any bullish price action. And vice versa for stocks that are way overbought, if the momentum is still so strong where we are seeing green days after green days without any exhaustion or any bearish price action, we wouldn't also take profit for this example in summary. So it's a hard answer to actually give, but basically TA is not just looking at one parameter and then deciding what to do, but it forms more of something that is a wholesome view where we have to take certain parts into the equation, and more importantly is individual price action.
Okay, thanks, Jeremy. Let's take a look at the next question. Do you move between time frame for trend and exit entry? What is the situation you do that and steps you do that?
Yep. So for time frame wise, yes, that actually forms my first part of analysis for any stocks or asset class. And usually how I would do it is looking from the longer term time frame first to get the rough gauge of the general long-term trend. So probably a good way to start off is to look at the weekly time frame to see the rough configuration of the moving averages. And if we have a nice long-term uptrend, chances are in the daily time frame, which is the short time frame, we will likely be looking at a strong uptrend as well. And for that, probably once that is formed, then we will be looking for buying opportunities at each correction phases along, say, support level or the moving averages level.
Okay, let's take a look at the next question. Would you suggest the Bollinger Bands indicator used with RSI and MA as well?
Yep, so Bollinger Band basically is yet another derivative of a moving average. So basically, again, looking at a similar thing, but just in a different form. So for Bollinger Band, I think it works well for uptrending stock if you were to look for buying levels. So like I mentioned, my way of using the moving averages is looking at 3 different buy levels. If we have an uptrend, the first level will be 20-day, 60-day, followed by 200-day. Those will be the buy levels for using my way of trading. However, again, like you say, Bollinger Band does actually work from that perspective as well. If you were to plot a 20-day moving average with the Bollinger Band, you do actually also have your own respective levels of buy guide over there. But however, I think what works better for me is just looking at the 20, 60, and 200-day as my guide. But as a whole, again, there isn't one standard answer to all. And I guess what works for you would likely be something that you will be more comfortable with and you will likely trust more. So for traders, for investors, I think it's still something that is a trial thing where we kind of move forward and experiment. And if you find something that works for you, I think that is something that you can actually stick on to and probably don't have to really follow what the rest are actually using.
Okay, I think we have a few more questions, so do stay with us while we address these questions. EMA versus MA, may I know which one is more accurate and what's the difference between in applying this to?
Yep. So basically the reason why I'm using the exponential moving average is because what it does is it gives more credit or gives more weight to the most recent price action, which means you are getting more life up to date kind of a moving average as compared to a standard simple moving average, which equal weights the past, say, 20 days of price movement. So if you were to ask me in terms of what is more accurate, probably I would say the exponential moving average is more accurate. However, again, industry standard wise, there is still two different camps, some that uses both, some that sticks to just one, like me, just using exponential. But at the end of the day, the difference over here between an exponential moving average and simple moving average, if you were to plot it out on a chart, the difference over there isn't really that huge. So it will still work pretty similarly, even though if you're using exponential one or the simple one.
Thanks, Jeremy. Let's move on to the next question. Is MACD a good indicator beside RSI? And how do we make use of MACD in TA?
Yep. So for MACD is pretty similar. It's another derivative form of a moving average, which is also why I don't really use them, because moving average is already a second derivative of price, and then MACD is actually a third derivative of price, which then kind of lags over there. But nonetheless, if you were to look at the MACD, it does also present a similar characteristic as looking at the RSI. When it's oversold, it's when you look to buy, and same thing when it's overbought, you look to sell. So for MACD, what we will look out for is when we have the crossover signal happening from the bottom end of things. Once we get the bullish crossover signal, usually that is also when we see the RSI bouncing back above the oversold level, thereby presenting a buying opportunity. So pretty much stochastic, RSI, MACD, they pretty much show a similar thing, which is why I don't really use all three rather than just sticking to one. Basically, they are telling the same thing.
Okay, thanks, Jeremy. Let's take a look at the next question. What about Smart Money Index, banker chip software promoted by Homily?
I'm actually not too familiar with this, so I guess I don't have comments. Yeah, sorry about that.
Let's take a look at the next. Yeah, is it good to use OBV to see the money flow?
Yes, to a certain extent, but again, if you were to look at OBV, this is one that isn't really much used by the community. So then henceforth, the relevance of it in terms of looking it on the price action chart will likely be less relevant as well. Again, what we would like to do over here looking at TA is to use things that are widely used or mostly used by the community. So OBV is one that isn't really widely used. And I think it works better for commodities as well as for indices. So short answer is it still works to a certain extent, but it doesn't really work that well for my analysis, which is why I don't really stack them into the kind of a chart that I'm using.
Okay, thanks, Jeremy. Let's move on to the next question. For Forex, there's no volume. What is a good substitute?
Yep, so that presents a problem. So that is another form of volume for Forex, which is the tick volume, which then isn't really representative of the whole volume because there isn't really a centralized marketplace that actually calculates the volume, which is why probably for FX volume doesn't really play that much of importance over here, because then everyone is looking at the different data. And even if you look at FX right now, the market movement over the past few months, or I would say years, have been pretty much a muted kind of a market, very different from what we saw like 10, 20 years ago. And probably I think the interest for FX market have right now shifted into the US equity markets as well as the cryptocurrency market.
Okay, let's take a look at the next question. Will this strategy work for lower time frame x 1 hour?
Yep. So for this case, I think if you're talking about 1 hour, 4 hour, or even like 15 minutes, it all depends on the asset class you're looking at. So for this case, if you're looking at Singapore stocks, definitely I would say the lower time frame don't work because we don't have that liquidity. However, for lower time frame, I think it works on the FX market where TA actually drives the market around. Other market for lower time frame that works, I would say probably for equity indices in the US, such as your Dow, your S&P, as well as NASDAQ 100, those will likely work for active traders, or I would say intraday traders. Even cryptocurrencies such as Bitcoin, Ethereum, I think lower time frame does work because those are what traders are relying on in terms of forecasting where prices are heading into. So in short, I think it depends on the asset class you're looking at.
Thanks, Jeremy. I think we have 2 more questions to address. So let's take a look at the next question. Do you believe in seasonal trading?
Yep. So if I'm interpreting the seasonal trading, what you mean by seasonality, then I do believe seasonality to a certain aspect because it is part of TA in terms of how we analyze market movement in terms of how it's trading throughout different months. And if you were to look back in time, seasonality does actually play out in terms of seeing some sort of a rally into the new year. And the key reason for the New Year rally is due to the fact where hedge funds started to rebalance their portfolio for the start of the year, which is also why probably we will have the effect of New Year bull run going all the way through to March. So there could be some fundamental reasoning behind seasonality. And in terms of the other seasonality that we mentioned, probably the sell-off usually happen in 3Q, 4Q of the year. In October and November, if you were to look back, usually market crashes happening during those period of times. So I guess the anecdotal evidence over here does suggest seasonality does actually work to a certain extent.
Thanks, Jeremy. I think we have one last question to address. Let's take a look at the last question. For buying selling opportunities, do you use the daily or weekly RSI?
Yep. For this, most trading calls or trading decision will be made on the daily time frame because we want to get the data that is most live up to date on the day itself. So I would say the short answer is to look at the daily time frame to pinpoint your trading decision. However, I think it still doesn't really hurt you to take a look at the daily time frame as well. So what we would like to have in the best of all worlds kind of a scenario is when we have stock or asset class that have an oversold weekly RSI, and also at the same time the daily time frame is also showing an oversold RSI. Usually in that kind of a scenario, that asset class will likely be trading real close to a bottom, and usually for those kind of asset class, it will likely have a limited downside. So once we have that, what we would like to do is then wait out for buying bullish price action to appear on a daily time frame to kind of signal to us probably that is the time to actually enter to the market to time the bottom.
Thanks, Jeremy. What you have shared with us is very insightful. And thank you everyone for joining us tonight. For any queries, you may still reach out to us via email at hello@prosperus.asia. Before you go, do help us fill in a short survey for us to understand you better. For those on Zoom, the survey will actually pop out after exiting today's session. And those who are actually on Facebook, please do scan the QR codes on the slide shown or the link below. We hope to see you in our upcoming sessions, and good night.